You know, leaving a country is a huge life decision. But for Americans, it can come with a pretty hefty and, frankly, often surprising price tag. Today, we're going to dive deep into the US expatriation tax. It's a complex topic for sure, but it's absolutely crucial if you're even thinking about a future outside the United States.
So if this question has ever crossed your mind, then you're in the right place. We're going to break down exactly what you need to know about the financial side of making that choice.
All right, so the official name for this is the expatriation tax. It all comes from the Internal Revenue Code, Section 877A. Think of it as a final tax bill you might have to settle with the IRS on your way out the door.
Now, right away, let's clear up a huge misconception. This tax isn't just for US citizens. Nope, it also applies to folks called long-term residents. Basically, if you've had a green card for at least 8 out of the last 15 years, you're on the hook too. The net is way wider than most people realize.
Here's a quick look at our roadmap. We'll talk about the price of leaving, figure out if you're a covered expatriate, explain the wild concept of a deemed sale, look for exceptions, talk about a super important form, and finally a little bit about relief for some former citizens.
Okay, let's get right to the absolute heart of the matter. Everything, and I mean everything, boils down to whether or not the IRS classifies you as a covered expatriate. This is the first, most critical question you have to answer.
So what in the world is a covered expatriate? It's just the legal term for someone who trips the wire on the exit tax. And here's the key. You only have to meet one of 3 specific tests. If you're not a covered expatriate, you can breathe easy. The exit tax just doesn't apply. But if you are, well, that's when things get serious.
So these are the 3 tests. Remember, failing just one of them is enough to get you flagged. First, the net worth test, pretty straightforward. Second, the Tax Liability Test, which looks at your past tax bills. And third, and this one trips a lot of people up, the Tax Compliance Test. Let's look at the numbers for the first 2.
For the net worth test, the magic number is $2 million. That's your total worldwide assets. But here's the real kicker. That number is not adjusted for inflation. It's been stuck at $2 million for years, which means as time goes on, more and more people are going to hit this threshold. The second test is all about your tax bills. If your average annual income tax for the 5 years before you leave was over this threshold, which is $201,000 for 2024, then boom, you're a covered expatriate. Now, unlike the net worth test, this number is adjusted for inflation every year. So that's something. Okay, so let's say you are a covered expatriate. How on earth does the IRS figure out what you owe? Well, this brings us to a really interesting, kind of strange concept called the deemed sale.
And this is exactly what it sounds like. The IRS literally pretends that you sold everything you own, your stocks, your house, your business, anything, anywhere in the world, for whatever it was worth on the day before you officially left. You then owe capital gains tax on the profit from that imaginary sale.
This quote just nails the problem, doesn't it? It's a tax on phantom income. You haven't actually sold a thing. No cash has hit your bank account, but you still have to come up with very real money to pay the tax bill on those on-paper gains for assets you still own. It's a huge liquidity challenge.
Now, it's not all bad news. The law does give you a bit of a break. You get an exclusion on those capital gains. For 2024, the first $866,000 of that phantom gain is totally tax-free. And just like the tax liability test, this amount gets adjusted for inflation, which is a really important detail for planning.
So what if you meet one of those first 2 tests, the net worth or the tax liability one, but you feel like this whole thing shouldn't apply to you? Are there any ways out? Well, yes, there are a couple of very specific, and I mean very narrow exceptions.
The main one is this dual citizen exception. But listen, the rules are incredibly strict. First, you had to be born a citizen of both the US and another country. So if you were naturalized, this isn't for you. You also have to still be a citizen, and this is crucial, be taxed as a resident of that other country. On top of that, you can't have been a US resident for too long, no more than 10 of the last 15 years. And even if you check all those boxes, you still have to pass that third test, tax compliance. And that brings us to what might just be the single most important piece of paper in this entire process, Form 8854. This form is the absolute linchpin. It holds the whole thing together. Let me be as clear as I possibly can be on this. There is no situation where you get to skip this form. Filing Form 8854 is mandatory. Full stop. It is not optional.
So what does this form actually do? Well, it serves two main jobs. First, it's how you formally tell the IRS, hey, I'm out. And second, and this is the really big one, it's where you swear, under a penalty of perjury, that you've been a good taxpayer and followed all U.S. tax laws for the last 5 years.
And if you think you can just not file it, think again. The consequences are severe. If you don't file, you are automatically branded a covered expatriate. It doesn't matter if your net worth is $10. You also get hit with a $10,000 penalty. And maybe the scariest part? The clock for the IRS to audit you might never, ever stop ticking.
Okay, but what about people who were genuinely clueless about all this? You know, the so-called accidental Americans who might have lived their entire lives in another country. Well, back in 2019, the IRS actually created a special program to give these folks a path to get right with their taxes.
This relief program is built specifically for those folks whose failure to file wasn't on purpose. But to get in, your net worth has to be under that $2 million mark, and your total tax bill for the last 6 years has to be $25,000 or less. If you fit that profile, you can get compliant without getting hammered by the exit tax.
So after all that, after looking at the tests, the deemed sale, the compliance nightmares, the final question really just comes back to you. The decision to expatriate is about so much more than just feelings or politics. It really demands a cold, hard look at the numbers. Does it actually make financial sense for you? That's the question you have to answer.